Welcome back, traders and investors. We have Ryan Detrick on the line. He is an independent trader and market technician. Has been going at this for about 15 years. Ryan, how you doing today?
Hey, Joel, I'm doing well. In Ohio here. It's a little cold and rainy, but, excited to talk about the markets with you today, and I'm honored to be back.
Okay, could you give us a little bit of your education and then your market background and how you ended up doing what you are today?
Sure. Well, I kind of got the bug with the stock market back in 1999 in college. Kind of realized, hey, everything's going up. This is easy. And then, of course, it crashed, and I lost, all my money because I was on margin like everyone else. But again, I got the bug from that, and I just knew that was what I wanted to do. And then I worked at Schaeffer's Investment Research here in Cincinnati, Ohio, for over a decade until just recently. And they're a large options newsletter, so I did a lot of research, a lot of trading with them. And recently, I've just kind of branched out and doing my own thing, trading on my own. And I was just, about, I guess, 3 weeks ago, named an officially Yahoo Finance contributor, guys like Josh Brown, Carl Icahn, Ralph A. Campora, and Greg Harmon, who's been on with you guys before. About 30 guys were chosen. So a lot of my market thoughts are now pushed out on the Yahoo Finance, and you can read them on Tumblr, yahoofinancecontributors.tumblr.com, or Ryan Dietrich, all one word, .tumblr.com is my market thoughts. And it's really cool because it's gotten a lot of the stuff I'm writing now, literally thousands of people can read it, and it's been a nice thing for me. And Yahoo's branched out and got these various contributors, and it's a different way to share information that it's kind of cutting edge, in my opinion. I'm excited to be part of that.
Yeah, and our founder, Jason Rasnick, is a contributor to that as well. So let's talk about your
Awesome.
your experience here in 1999, 2000 when you got started trading. Was it were you just complacent? Did you have some nice gains and you didn't lock them in? Or did you add to losers? Or really, kind of walk us through that and try and give us one, two, or three of the most valuable lessons you learned from that experience.
Sure. Well, again, that's right when, obviously, you think back to then, the tech bubble was going on, and my dad had gave me like $3,000 or $4,000 to open up this was an it was an E-Trade account back then. But anyway, I quickly made it up to like 16,000. I was on margin all the way watching CNBC. They talk about Sycamore Networks, talk about any of those names we remember back in the day, and they go up. So you just buy them, they'd go up. I was like, well, this is easy. And as we all learned, that wasn't the case. Most of the stocks don't exist anymore. A lot of them dropped 90%. What I really learned from that, I guess, a few things. One of the main things I learned is markets don't go up forever. And we've seen that a couple different times the last 14 years. Also, when things go up and they do come back down. The guest before me, I liked what he mentioned. He said, bear markets are actually a good thing. And I think that's true because it kind of gets rid of the excess and gets rid of some of the Johnny come lately, like myself back in 1999 and a lot of other people. Staying off of margin is another thing that I learned back then that, it's twofold. You make a lot going up, but you can lose more going down. And the other thing I learned just from a trader's point of view, I had no idea you could really short stocks back then because, again, I just started. But, I learned after the fact that, yes, you can make money going up, but you can make money going down. So from a trading point of view, your zero-sum game, you can argue if that's true or not. Nonetheless, it really struck me as fascinating because you can make money either way. And then just the whole sentiment. I've got lots of stuff we can talk about here regarding sentiment, but it's also the sentiment factor to things. How, yes, we all look at price action, we all look at fundamentals, but when you overlay sentiment, I know I was back on with you guys on July 16th was the last time I was here, and I said, various sentiment indicators that I'm looking at are flashing. There's a little too much complacency out there. That doesn't mean we have to crash, but it says the expectations are much higher, and we could have some type of pullback. And sure enough, 4 or 5% pullback since then. I know we bounced Friday, but that's kind of a neat way to look at the market when you also overlay sentiment to your trading, which I don't. Not everyone does it, but I think it's a definite powerful thing that can improve your trading over the long run.
Yeah, I remember that because you sent me a bunch of information before you came on the show showing your sentiment indicators. And That was an excellent call. Going fast forward to last week and to now, boy, you had a geopolitical situation really affect the markets earlier in the week. They were just sure that Russia was going to invade the Ukraine and really took the wind out of the market, took it down under 1900 in the S&Ps. How do you? I mean, when if you're trying to be a disciplined trader, how do you react to the geopolitical news? I mean, it's hard to ignore that news. Like if you're a long trader, I believe it was on Wednesday. I mean, how do you interpret it, and how do you let it really not affect your longer term strategies?
That's a great question. I mean, it's easy to say just don't pay attention to it, but it's never, it's obviously never that simple. I mean, you're just simply looking at, the charts, like look at the QQQ, the NASDAQ 100. I mean, it just pulled back to its 50-day moving average. So we know technology, specifically big cap technology names, are doing well. If you just throw out all the news and just look at the chart, it's a relatively modest pullback to the 50-day moving average and now bouncing off. So that's a good thing. But again, it's funny. Well, it's not funny, but it's a fact. A year ago right now, we were talking about potentially having a 1987 crash, and a lot of people were talking about that, how there's just, the market's not too far too fast, and again, all this negativity. And every pullback that we've seen since then, and, even now, on the modest pullback, how much fear can really come in. The AAII, the most bearish number of bears since August of last year, just came out last week. It's the first time since May 2013 we've gone three straight weeks where the bulls have not been greater than the bears. So some pretty good persistent bearishness. Now, again, if you look at the headlines out there, a lot of scary things have been well documented. So that makes you, under the surface, scared. You've seen those headlines. But then you look at last week where we finally saw, leading up to Friday's big bounce, small caps quietly finally taking a little bit of leadership. And we know how horribly small caps have done, but you got some leadership under the surface. And the sentiment is just getting, I think, very over the top bearish on a pretty modest pullback when you look at the overall market. But again, it's a scary headline. And then when you don't have all the negative things, like on Friday we had some good news, some good rumors about, maybe things turning around. And sure enough, you have, I think, fourth biggest day of the year on a percentage basis on the S&P 500. So that's kind of how I like to look at the market. Sure, I pay attention to headline. And let's be honest, news, old saying, I'm a technician, but news trumps charts. You can have the most perfect chart in the world and say your sentiment indicators all line up, but if there's news, you can throw all that out the window. So it's definitely a lot harder, I think, as a trader when there's a lot of geopolitical news that can move the market. But, honestly, for years now, every time we have a sell-off, it seems like it's blamed, 2011, the geopolitical issues back then. Last year, again, right around now, early September, we were going to war with Iran was, kind of the rumors, the talk, and that all the fear we had back then. And sure enough, we're up the last 5 months of last year when none of that materialized. So to me, you pay attention to it, but you do your best to ignore it and just follow the indicators that you're the most comfortable with. And to me, it's kind of following the sentiment indicators and also definitely paying close attention to overall price action.
So let's talk about some of your indicators. I heard you throw in the 50-day moving average. Can you talk about some of the other indicators that you use, or the charts or chart patterns that you like to rely on?
Sure, absolutely. I mean, there's a handful of them, but one that I've just recently been writing about and talking about. Everyone knows, the VIX. The VIX is, of course, volatility pretty much over the next 30 days. And something that happened just recently that I think is neat, and it's a neat indicator, if you look at the VIX, that's again over the last 30 days, but if you look at the VXV, that's volatility over the next 30 days. So it's longer term. Now, to keep this simple, just technically 2 weeks ago now, and that big 2% drop we had a couple Thursdays ago, that became inverted. In other words, usually you're going to pay more for future volatility. That just makes sense. You're going to own something for 3 months, you're going to pay more. But when it becomes inverted, and you're actually going to pay more for the current VIX versus the 3 month out, that's rare. And that's only happened 7 times since late 2012, and it just happened for the 8th time just recently. And if you look at the return, which I did, you look at the returns when the VIX term structure becomes inverted, it's extremely, extremely bullish. I've got it here in front of me. 3 months later after it happens, it's happened 7 times since late 2012. S&P is up 9% on average, up 100% of the time. That's 3 months later. 6 months later, technically it's happened 6 times, up 12% on average, up 100% later. A year later, and 4 times, 24% on average, 100% higher. So, again, we've been in a bull market. Let's not fool ourselves. I can give you any stats, and most of the returns are probably going to be strong. But when I see something like that says there's that much fear out there on, scary headlines, modest pullback, and the VIX term structure becomes inverted for the 8th time now in the last 15 months or actually longer, year and a half or so. That to me is one of those things that a lot of people don't necessarily always talk about, and those are the indicators I'm looking for, the things that people aren't always necessarily talking about. So that's a neat one that I think is pretty powerful. And what I wrote just Friday talking about it is after the first week, after this indicator just flashed, the market was actually down 1%. That was the weakest 1 week return after this indicator, signaled its buy signal, if you want to call it that. So, the contrarian in me says, okay, it's worked for so long, and now it's starting to slow down. But then we did have that good bounce Friday and a little bit of a bounce today. So, my take is you want the market to start bouncing pretty fast here. And if a previous bullish indicator stops working, that's a huge, huge warning sign. I'm not ready to say that yet because, again, the strength on Friday and maybe continuation today, but that's something I'm watching very closely.
And just talking about that rebound, I mean, the S&P's got down to 1890 and a quarter, coming off that 1985-75 high. I'm a big fan of, I wouldn't really call it the Fibonacci's. I like to primarily focus on the 50% retracement, which put you up near the high from last week at 1937.50, right there, 1938. For me, if it could get today through that level, blow through that level, then hey, I'd be convinced we're going up to new highs. What are you looking at for confirmation? Because we just have had a monster rally since that pre-market low on Friday at 1890 and a quarter. It's just a little bit too much too fast. And what would convince you that we're just like this is just the move? You're never going to get a chance to buy the S&P futures in 1910 again. And you mentioned today is a critical point. Is there a particular level that you're looking at, or sentiment indicator? What are you looking at to I don't want to say confirm that that 1890 quarter is the bottom, but what would you like to see in today's trading that would give you the confidence that this is just not fluff from Putin pulling back his troops?
Right. Well, if you just look at the S&P, like you said, we were down to 1910 just a few days ago. Bigger picture over the course of the next week or two, I definitely want to hold above that level. I don't think there's any shock there. But, right now, in the near term over this week, this is August expiration. Historically, option expire this week. Last year, look at all the option expirations. The weakest one actually was August 13th. It was August last year, down 2.1%. Seasonality the last 4 years, August expiration week has actually been down, and 2 of them were down. One of them was down, like I said, last year 2%. This year, or 2011, was down over 4% for the week. So near-term seasonality is a little bit of a concern. So I just want to hold tough this week and not see any big selling. Now, if we can be back above 1940 or so in the S&P, close above that. That's kind of the peak we had last week there. At least on an intraday basis or a closing basis, on a closing basis. We can get above 1940, that could be the definite first step in the right direction. But, we're getting real near term and just bigger, a little bigger picture. And this has been documented before. Look, since 1950, if you look at the average monthly returns, we are in the only 2 months, August and September, that average a negative return back to back. August is down a little bit, and September is the weakest month, at least since 1950. So, in the back of your head, or back of my head at least, I'm always thinking, okay, seasonality, there is some potential concerns here, and no doubt we've got some breakdowns across the board, but the S&P and the big caps are still holding up. We know the small caps have lagged, so that's just kind of what we've been seeing, but we also have seen that that can continue for a while, so I'm not ready to throw the towel on the bull market for that reason at all. I mean, one other neat stat that I looked at recently, you look at the first half of the year, since 1950. The first half of the year, at least in the S&P 500, the first half of the year averages 4.16%. That's the average. And when you have an above-average year, so above 4.16%, like we were this year, the second half of the year is actually up 82% of the time and up about 7% on average, versus the average second half of the year up 70% of the time, up about 4.5% of the time. So it's kind of it confirms strength equals strength. I mean, some of the rare times we've actually had a 10% gain the first half of the year. Those second half of the years have even been stronger, specifically last year. So all in all, yes, seasonality near term is a concern. Bigger picture, I still think this bull market's intact. The S&P 500's 200-day moving average. We've been above it almost 440 days in a row. We were above it 525 days in a row back in the 90s, and there's actually over 600 days in a row. I think it's 1956 when that one ended. But you could argue this rally is long in the tooth, and I would agree there. But again, when you look at how much people panic on any of the pullbacks we've seen, another neat one that I just looked at, the NAAIM Exposure Index, which looks at, again, active managers. To keep this simple, last week it had the seventh largest point drop ever. So we had a modest pullback. And active managers, this is real money. You could argue the AII, they call 100 guys, and, it's grandpa reading the headlines, and he panics. And maybe you do want to use some as a indicator, but still people say, oh, the AII, don't pay attention to that. It can be maybe, too random. But the NAAIM Exposure Index of active investment managers, they outright panicked with the seventh largest drop ever last week. So again, those are things that I like to see. And if the price action can confirm and start to move higher, if we can, obviously what that means is build on Friday, the negative sentiment is out there, and that's what we've seen for a while. So, again, the guests before me, you guys are talking about everyone's condition is to buy the pullbacks, and that is, that is true. You could argue just do it till it doesn't work anymore, and I'd agree to that. But as long as we keep seeing all this real fear, maybe headline-driven fear, I think you want to continue to be a buyer of dips, at least when it comes to the big cap names. I think big caps are still going to be the area that lead us. Small caps had that 13-year run. I think that kind of ended this spring, and I think small caps will continue to lag, but big caps specifically probably will keep doing well this year, I think.
Okay, so you primarily you rely on the cash, the S&P cash, because the levels you were given seem to correspond more to the cash index. Is that what you base your most analysis on, as opposed to the? Because I kind of lead towards the futures because they're open around the clock, and they certainly do a lot of movement without the cash open. So is the cash your preferred method to follow the market?
Honestly, yeah. Again, I'm not more of I wouldn't call myself much of a short-term trader. I like doing market studies and kind of looking for longer-term indicators, so I don't keep it simple is the way to put it. But yeah, I do seem to focus more on the overall cash, S&P cash, and, layering on, like we've been talking about, the different indicators and some indicators when it comes to things. So, yeah, I'm not, again, it's not necessarily a short-term trader, more of an intermediate-term swing trader, I guess. So that's what I like to focus on.
Okay, well, I got a whole list of questions here as I didn't even get to, so we're going to have you on again soon. Thanks a lot, Ryan. Ryan Detrick, independent trader and market technician, giving his outlooks on the market, what he likes to follow, what indicators. Thanks a lot. Have a good trading day. We'll talk to you again soon.
Thank you, Joel. Talk soon. Goodbye.